Hello everyone. Now let's continue our discussion about differential analysis, and we're going to see another situation where we can apply differential analysis, which is a situation where we decide whether to accept business at a special price. And by special price, it's a price that's lower than the normal selling price that we deal with. So a company may be offered the opportunity to sell its products at prices other than normal prices. And again, as I mentioned, it could be a lower price than the normal price. So differential analysis can be used to decide whether to accept additional businesses or business at a special price by comparing the differential revenue to the differential cost of producing and delivering the product to the customer. So differential cost depends on whether a company is operating at less than capacity. Additional production would not increase fixed manufacturing cost. So let's see an example here about a company. It's called B-Ball Incorporated. It manufactures basketballs, and their monthly productive capacity is 12,500. Their current monthly sales is about 10,000 basketballs. So you can see here they still have more in their capacity. So the normal domestic selling price is $30 per basketball. The variable and fixed cost are $12.50 as a variable cost per basketball, and the fixed cost is $7.50 for a total of $20 per basketball. So the difference is their profit. So we have a situation here where they have a special order. So they received a special order offer for 5,000 basketball at $18 each, which is $12 below what they normally sell it for. So production can be spread over 3 months without interfering with normal production or incurring overtime cost, and pricing policies in the domestic market would not be affected either. So in the next exhibit, we'll see that the special business is accepted even though the sales price of $18 per unit is less than the manufacturing cost of $20 per unit, because the fixed costs are not affected by the decision and thus omitted. So in other words, the most important thing we focus on when we are having a special offer or special order is the variable cost. So if we can cover our variable costs, we should go for it, as long as this is something that's additional to what we are already doing and it's not going to require any additional resources. So the only thing we focus on is the variable cost. And you see here the variable cost is $12.50. We're getting the special order for $18, so it should be profitable. But we'll try to prove that using the differential analysis. So proposals to sell products at special prices should also consider some of the following issues. So things like special prices in one geographic area may result in price reduction in other areas, resulting in a decrease of total company sales. Because once we start selling at $18, maybe other markets would start knowing that we're selling our product at a cheaper price, which can create a pressure on reducing our price in different areas. Also, there is something called the Robinson-Patman Act. So manufacturers must also conform to the Robinson-Patman Act, which prohibits price discrimination within the United States unless price differences can be justified by different costs. So here's our analysis. You see, if we decided to reject the order, our revenue would be zero. We don't have any variable costs, which is our focus here, and the profit would be zero. Again, for this additional kind of order. But if we accept the order, the revenue would be $90,000, calculated as the additional 5,000 units multiplied by $18 per unit. That's $90,000, and the variable cost or variable manufacturing cost is going to be $62,500, calculated as 5,000 units multiplied by $12.50, and that's $62,500. So our profit in this case is a positive number, which is $27,500. So if we do the differential effect, you see that again, there's actually a benefit in accepting the offer because we have a positive profit in this case. So let's try to test our knowledge, and that's our very first knowledge check for this chapter. So it says here, costs that have been incurred in the past cannot be recouped and are not relevant to future decisions. What we call them? These are called, is it variable cost, opportunity cost, sunk cost, or fixed cost? No, I think the word incurred in the past cannot be recouped. I think it makes it very easy because it's sunk cost, and sunk costs are not relevant anymore. They're sunk. You incur them, and your decisions are not going to make any differences in the sunk cost. So sunk costs are costs that have been incurred in the past, cannot be recouped, and are not relevant for future decisions. An example is the book value of an old piece of equipment in a replace equipment decision, and therefore it's irrelevant. So, like a cost that I incurred for my old car should not be a factor in my decision to buy my new car. Of course, we try to compare sometimes, but it's sunk cost. It's not really going to impact anything. So that's why we consider that to be sunk cost, or what I can refer to as irrelevant cost. Now let's talk about setting normal product selling prices, which is another important topic in this chapter. How we decide on setting our selling price. So normal selling price is the target selling price to be achieved in the long term, which must be set high enough to cover all costs and expenses. And many businesses, they fail because they don't do this right. They try to be competitive in the market, and they forget that their price has to cover their fixed cost, their variable cost, and also provide some reasonable profit. Because if you price your product at a value that would not be able to cover your fixed and variable cost and generate some profit, then you will not be able to survive. Remember in the previous example when we said fixed costs is not relevant in this additional offers? That's true. But in the normal selling price, pay attention here to the word normal selling price. You need to make sure that you are covering your variable costs, your fixed costs, and also be able to generate reasonable profit. So managers can use one of two market methods to determine the selling price. Either the demand-based method, and the other one is called the competition-based method. And again, these are market methods. Okay, these are methods that are based on the market. So one is based on the demand, and the other one is based on competition, or what the competitors are selling the products for. So the demand-based method set the price according to demand for the product. So the dynamics of economics are the reason how we decide on the selling price, so supply and demand. And the other thing is the competition. So the competition-based method sets the price according to the price offered by competitors. So we try to be within the same range within competitors. If we believe our product is better, we can raise it a little bit compared to our competitors. If we're trying to compete on the price, then in this case we can lower a little bit compared to our competitors. We can also use something called the cost plus method. So managers can use one of three cost plus methods to determine the selling price. So we have something called the product cost method, the total cost method, or the variable cost method. So we'll be talking about the product cost method in more details. So the cost plus method and product cost method. So we'll start with the cost plus method. This determines the normal selling price by estimating a cost amount per unit and adding a markup computed as follows. So we have the cost amount per unit, and then we add a markup. So we see how much it costs us to get a product, and then we add a markup. And that would be our normal selling price. So management determines the markup based on the desired profit for the product and must be sufficient to earn the desired profit plus cover any costs and expenses that are not included in the cost amount. What do I mean by that? So under the product cost method, the cost of manufacturing the product termed the product cost are included in the cost amount per unit to which the markup is added. So estimating selling expenses, administrative expenses, and desired profit are included in the markup. So cost here is just a pure cost. The markup includes estimated selling expenses, administrative expenses, and the desired profit. So we have to keep this in mind. So it seems like it's like the overhead plus the desired profit. So let's try to see this like in a way we can visualize it. So in the product cost method, we see the manufacturing cost here, which is how much we incurred to get the product ready, plus the markup. And the markup includes three parts: the administrative expenses, the selling expenses, and the desired profit. So when you combine these together, that's the desired selling price. So let's see an example. So the product cost method is applied using the following steps. We have here 6 steps that we're going to follow. The first step, assume the following data for a company that manufactures calculators. We have here 100,000 calculators. The company is called Digital Solutions Incorporated. They expect to produce and sell during the current year based on the following information. So they have direct material of $3 per calculator for a total of 100,000. That's 300,000. The labor is $10 each, so that's $1 million. The factory overhead is 200,000, and that gives us a total product or manufacturing cost of 1.5 million. If we add these 3 numbers, material, labor, and overhead, these are the manufacturing cost. Okay, and remember, that's still part of the product cost. Okay, I'm sorry if I said overhead for these things. That's a different kind of, I mean here, like the product cost includes the variable material, variable labor, or direct material, direct labor, and the factory overhead. Then we have the selling and administrative expenses to be $170. That would make the total cost $1,670,000. The total assets in this investment or in this company is $800,000. The expected desired return of 20%. So 20% of the assets invested in the company. So the first step, we need to estimate the total product cost. And here we have the estimated total cost to be $1.5 million. It's again the direct material, direct labor, and the factory overhead. The second step is to estimate the total selling and administrative expenses. And that includes the $170,000 selling and administrative expenses. That was given to us. The third step is to divide the total product cost by the number of units expected to be produced and sold to determine the total product cost per unit. So remember, our total product cost was 1.5 million. The estimated units produced and sold is $10,000. So the cost per unit, the total cost per unit is $15. Now that's a good number to start with because we are going to add to that number the markup. So the desired profit is the fourth step. We compute the desired profit and the markup. So the desired return multiplied by the total assets is 20% of the 800,000. That's 160,000. But remember, we also need to cover our selling and administrative expenses. So the markup percentage would be the desired profit plus the total selling and administrative expenses divided by the total product costs. So we have the 160,000 plus the 170,000, which is 230,000 divided by 1.5 million, which is what we had in step number 1. So remember, in step number 4, we are actually getting the desired profit plus the selling and administrative expenses divided by step number 1, which is our total product cost. And that would give us 22%. 330,000 divided by 1.5 million, that's 22%. So now we know that our markup should be 22%. Remember, that's our cost per unit. So we take this percentage multiplied by the markup. So step number 5, we determine the markup per unit by multiplying the markup percentage times the product cost per unit. So we take the $15 multiplied by 22%, and that's $3.30. So the $3.30 is the markup per unit. We take the $3.30 added to the cost of $15, and that's step number 6 to determine the normal selling price. So the normal selling price is calculated as $15, which is the total product cost per unit, plus the $3.30, and that would be $18.30. So our normal selling price in this case, based on the product cost method, is $18.30. Now let's talk about something called the target cost method, the target costing method. So the target costing method is a method of setting prices that combines market-based pricing with a cost reduction emphasis. So under target costing, a future selling price is anticipated using the demand or competition-based methods and then computed as follows. So it would be the expected selling price minus the desired profit. So this is what we want to sell it for. This is what we hope our profit to be, and that would be our cost. So it's working the other way around. It's not like we're setting the cost or trying to calculate our cost and then we add the markup. No, we decide on the selling price. We want this profit or the desired profit. We subtract the desired profit from the selling price to see how much this product cost us. And then we try to adjust our cost in a way that would satisfy or meet the target cost. So the target cost is normally less than the current cost, and managers must try to reduce cost, because whenever you apply this method, usually it creates some kind of pressure on the cost. So the target cost usually ends up being less than the actual cost or the current cost that we're incurring. So managers try to reduce the cost using a variety of ways. So things like trying to make the design simpler, so simplifying the design, or trying to reduce the cost of direct material by trying to maybe buy in bulk or rely on suppliers who can provide us with better prices, or reducing the direct labor cost, or eliminating waste, which is the smartest thing to do, like try to eliminate the waste that are incurred in the process. So target costing is especially useful in very highly competitive markets, because you know that the selling price is somehow restricted. You cannot raise, you don't have the luxury of raising the price too much. Then you set your desired profit to calculate your target cost, and then you try to find a way to make the cost meet the target cost, or make the actual cost meet the target cost. So here's the current market price. Okay, this is the actual cost, this is the profit. You do this target cost method, you have the expected market price, you subtract from it the desired profit to get the target cost, and now you have to drift that actual cost to the target cost. So required cost reduction. Alright, so let me stop here. In the next video we're going to be talking about production bottlenecks.